Gold was sitting at $5,023 when this week opened. It is at $4,260 right now. Surprised. That is a drop of over $650 in less than 5 trading sessions, the sharpest weekly decline in 6 years. And simultaneously, Iran has fired missiles at the Israeli cities of Dimona and Arad, targets chosen specifically because Dimona sits next to Israel's main nuclear research facility, injuring at least 180 people. Rushed over the weekend, President Donald Trump posted a 48-hour ultimatum on Truth Social threatening to obliterate Iran's power plants if Tehran does not fully reopen the Strait of Hormuz by tonight. So let me ask you this question slowly. Gold just had its worst week since 2020, and there is an active war targeting nuclear sites in the Middle East. Those two facts are sitting in the same paragraph. Most commentary you will find today is treating them as unrelated. They are not unrelated. The reason gold is down is the same reason it is structurally positioned to move significantly higher, and understanding that mechanism is everything right now. Here's the math that does not work. The Federal Reserve held its benchmark rate at 3.50% to 3.75% on March 19th in what analysts are calling a hawkish hold. Producer prices came in at plus 0.7% month over month in February, nearly double the expected 0.3%. Brent crude is trading at $114 per barrel as of this morning, up from $65 per barrel before the war began on February 28th. That is a 75% increase in the global oil benchmark in less than 4 weeks. And yet the Fed is signaling 0 rate cuts for 2026, which means real rates, the rate you get after adjusting for where actual inflation is going, are being deliberately kept restrictive, while an energy shock is printing new inflation simultaneously. Gold fell because that combination squeezed leveraged positions and strengthened the dollar. But the same combination, if it persists for more than 60 days, historically inverts. JPMorgan published a note earlier this year raising their 2026 gold price target to $6,300 per ounce. They also put an $8,000 scenario on paper. By the time we are done here, you will understand exactly why those targets exist, why the current pullback is mechanically explainable, and what 3 specific developments in the next 72 hours will tell you whether the next move is down to $4,200 or up through $5,000 again. Start with the Strait of Hormuz, because that is the beating heart of everything else. According to S&P Global Market Intelligence, more than 100 tankers per day were transiting the strait before the war began on February 28th. Since then, just 21 tankers have made the crossing in total, not 21 per day, 21 total over 3 weeks. That is a 99% collapse in throughput. Lloyd's List intelligence data published last week confirmed that tanker traffic fell 81% in a single day when the war began. Roughly 500 million barrels of oil transit that channel every month, according to the same source. That is approximately 1/5 of the world's oil supply, now moving at near zero. Bloomberg reported this week that the strait remains closed to all but approved vessels, with oil and gas prices surging amid infrastructure attacks and Gulf crude production cuts. The International Energy Agency took the unprecedented step of releasing 400 million barrels from global emergency reserves in an attempt to stabilize prices. That release has partially worked. Brent briefly hit $126 per barrel last week before settling back to the $108 to $114 range, but it is a finite intervention against an infinite blockade. Now here is the layer that mainstream coverage is skipping entirely. Qatar Energy, the state-owned firm that produces roughly 20% of the world's liquefied natural gas, formally ceased production at its Ras Laffan and Masayid industrial city facilities after what it described as military attacks on its operating infrastructure. That is not a threat. That is not a warning. That is confirmation of a production halt at the largest LNG export hub on the planet. European natural gas futures jumped 30% after that announcement. 1/5 of global LNG supply does not simply reroute overnight. This is not an oil tanker taking the long way around the Cape of Good Hope. LNG requires specialized terminals, specialized carriers, and specialized regasification infrastructure at the receiving end. There is no alternate path that absorbs that volume quickly. The combination of oil disruption and LNG disruption is creating an inflationary compound that the Fed's current toolkit simply cannot address, because the Fed cannot drill oil or build gas terminals by raising interest rates. This brings us to the paradox that is visible in today's gold price. Gold typically rises during geopolitical crises. That is the textbook relationship. Yet gold is down more than 9% since February 28th, the day the war started. As CNBC reported this week, the dollar has emerged as one of the clearest safe haven winners of this conflict, not gold. The reason is mechanical. When the oil shock hit, it reignited inflation expectations and forced the Fed to hold rates higher for longer. Higher real yields are a direct headwind for a non-yielding asset like gold. Leveraged traders who were long gold going into March held crowded positions, and the combination of a stronger dollar at 104 on the DXY and revised dot plot projections showing only one possible cut in 2026 triggered forced liquidation. You can print contracts. You cannot print the metal itself. The paper price was sold. The physical metal did not disappear. To understand why this matters, consider the 1979 and 1980 precedent. The Iranian Revolution closed Iranian oil production and contributed to the second major oil shock of that decade. The Federal Reserve, under Paul Volcker, eventually responded with aggressive rate hikes. In 1980, gold hit $850 per ounce, what was then an unthinkable price, precisely because the combination of energy-driven inflation and a loss of confidence in monetary policy compelled a repricing of real assets. The 2026 environment carries structural similarities: energy shock, stagflationary pressure, central banks caught between inflation and recession. But there is one critical difference between then and now that makes the current moment potentially more significant than 1980. In 1980, central banks were net sellers of gold. Today, central banks are net buyers. JPMorgan's own data shows official sector purchases of approximately 863 tons in 2025. The bank projects 800 tons of central bank gold buying in 2026, elevated by any historical standard, driven by what its analysts explicitly call an ongoing, unexhausted trend of reserve diversification away from dollar-denominated assets. The People's Bank of China, the Reserve Bank of India, and national banks across the global south are not selling gold into this dip. They are buying it. That was not true in 1980. That changes the floor. Now, the honest counterargument, because it deserves to be stated fairly. The bearish case for gold right now is not trivial. The Federal Reserve held rates at 3.50% to 3.75% on March 19th, and its revised dot plot shows 14 of 19 participants projecting either 0 or 1 rate cut for the entire year. The dollar index surged past 104 on the back of that decision. Higher real yields and a stronger dollar are two of the most reliable historical headwinds for gold. The argument is that gold already priced in geopolitical risk on the way up to $5,600 in January, its all-time high, and the current correction is simply the market repricing a crowded speculative position back to fair value. Finance magnates analysts describe the current situation this way: the oil shock from the conflict is hurting gold's prospects by reigniting inflation and forcing the Fed to stay hawkish. That framing is technically correct, it is also incomplete. What it misses is that the current suppression mechanism is time-limited. The hawkish hold by the Fed works as a gold headwind only as long as the economy can sustain the growth side of the equation. If the Strait of Hormuz remains effectively closed, and as of this morning, Trump's 48-hour ultimatum has now begun its countdown, with Iran's parliament speaker threatening that power plants across the UAE, Saudi Arabia, Qatar, and Kuwait could be hit if Iranian facilities are targeted, the energy shock stops being temporary and starts being structural. The IEA's 400 million barrel reserve release buys weeks, not months. Asian stock markets opened this morning with Japan's Nikkei falling 3.5%, and South Korea's Kospi down 4.9% per CNN's live coverage. These are not financial sector problems. These are economies that are overwhelmingly reliant on Hormuz oil imports, and those economies supply a significant portion of global manufacturing demand for silver and other industrial metals. The same force suppressing gold today, stagflationary pressure from a sustained energy shock, becomes the argument for gold when rate cuts eventually become unavoidable to prevent economic contraction. There's also a development that deserves specific attention and that very few English-language outlets have connected to the gold move. Iranian Supreme Leader Mojtaba Khamenei, the new Supreme Leader following the death of his father in the February 28th strikes, issued a statement marking Persian New Year that referred to Iran's eastern neighbors as very close. Iran has continued shipping oil to China throughout the conflict, through Iran's own designated channel north of Larak Island in the Strait. One ship paid $2 million in a single transit fee to use that channel, according to the Wikipedia crisis timeline. China-linked vessels have been transiting on a limited basis through a route that Western ships cannot safely use. This matters for gold because China remains one of the largest gold buyers on the planet, and it is operating in this environment with a physical supply chain through the Strait that Western institutions do not have. The divergence between Eastern and Western access to resources during an active regional conflict is not academic. It is a live pricing mechanism. Here are the 3 specific things to watch in the next 72 hours, all of which are verifiable in public data. First, Trump's 48-hour ultimatum on the Strait of Hormuz expires tonight, Monday, March 23rd. The ultimatum was issued Sunday on Truth Social, demanding that Iran fully reopen the Strait or face strikes on Iranian power plants. Iran's parliament speaker has already responded by threatening that energy infrastructure across the Gulf, including in the UAE, Saudi Arabia, Qatar, and Kuwait, could be irreversibly destroyed if Iranian power plants are targeted. Watch for any official statement from U.S. Central Command between now and midnight Eastern Time. If there is a strike on Iranian power plants, Brent crude will gap up at tomorrow's open. If there is no strike and the ultimatum passes without action, watch for a dollar pullback as the credibility of the threat erodes. and a dollar pullback historically correlates with gold recovery. Second, gold's next critical support level, based on technical analysis cited across multiple sources this week, including finance magnates, sits at $4,200, the 200-day exponential moving average, and the line analysts describe as the structural bull-bear dividing line for the entire 2025-2026 rally. Spot gold is currently at approximately $4,367 as of today. That is $160 above that line. You can track this yourself in real time on any metal's price feed. If $4,200 holds on a closing basis through this week's sessions, the consolidation structure that has been building since January remains intact. If it breaks, the next support referenced in public analysis is $3,500, the starting point of the entire rally. Third, watch Qatar Energy for any production resumption statement. The company formally halted LNG output at Ras Laffan and May Said after military attacks on those facilities. Any announcement of resumed production would immediately ease European natural gas futures, reduce inflationary pressure on the Fed, and remove one of the key arguments for a prolonged hawkish hold. That pivot, from a Fed that is hawkish because of energy inflation to a Fed that has room to consider cuts because energy prices are stabilizing, is the catalyst that historically precedes gold's next leg higher. Be clear about the uncertainty here. Markets can remain irrational relative to structural arguments for months. The dollar could continue strengthening. The Fed could surprise with hawkish language that further pressures gold. The conflict could de-escalate faster than any model predicts. None of the structural arguments above are guarantees of price movement. They are the conditions under which price movement becomes mathematically coherent. What the data actually shows today is this. Gold fell because a war-driven oil shock paradoxically strengthened the dollar by forcing the Fed into a hawkish hold. That mechanism works precisely as long as the oil shock is temporary. The moment the economic cost of sustained oil disruption exceeds the Fed's tolerance for restrictive policy, which JPMorgan, Wells Fargo, UBS, Deutsche Bank, and Goldman Sachs all modeled when they published year-end gold targets between $5,400 and $6,300. The paper sell-off reverses against a physical market where central banks are buying 800 tons per year and have no intention of stopping. The war is not the cause of gold's decline this week. The war is the compressed spring. What determines the release is whether the next 72 hours show escalation or de-escalation in the Strait, and whether $4,200 gold holds or fails. JPMorgan put an $8,000 scenario on paper. That scenario assumes households begin meaningfully increasing their allocation to gold, which JPMorgan's own analysis described as currently underinvested relative to global asset allocations. That scenario does not require anything exotic. It requires the structural trend that is already in place, central bank buying, de-dollarization, real asset preference, to continue, combined with a recognition event that brings retail investors in with the same urgency they brought to equities during prior crisis episodes. Whether this week's military escalation targeting nuclear-adjacent sites in Israel is that recognition event, only the next few sessions will confirm. Here's what I want to know from you. Given that Brent crude is at $114 per barrel this morning and Trump's Hormuz ultimatum expires tonight, where do you think spot gold closes by Friday, March 27th? Above $4,400, between $4,200 and $4,400? Or do you think $4,200 gives way? Drop your number and your reasoning in the comments. The most analytically grounded response gets pinned. The next session after Trump's deadline is tomorrow morning. If there are strikes on Iranian power plants tonight, I will have analysis up before London market open. Subscribe with notifications on. If you are not watching this in real time, you are watching it on delay. Everything in this analysis is sourced from public data: CNBC, CNN, Al Jazeera, Lloyd's List, S&P Global, JPMorgan Research Notes, and the Federal Reserve's own published dot plot from March 19th. All sources are linked in the description. I am not a financial advisor. Nothing here is investment advice. The numbers are real, the sources are public, and you should verify every single one of them before making any decision. Your money, your research, your call.